The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Okay, it is Friday the 13th, actually.
Oh.
Good to have you back, Jeremy. And it's been a very interesting week. And we were discussing earlier, it's good that we're doing this on Friday morning rather than our usual Thursday evening slot, because last night was quite sad news from the Middle East in terms of Iran and Israel.
Obviously, it's all kicking off, isn't it?
So interested to hear your take on that.
Yeah, it's hard to know what to make of it, really. But I would say that at this stage, markets are hardly in meltdown as a result of what's happened. Oil is up sharply, was up over 10% as we speak. When I last checked, was up 5 or 6%. It's a huge move in percentage terms, not unprecedented, but we're only back where we were in March this year. So I think the response in financial markets is interesting, and all the things are happening that one would expect in a risk-off move. Gold is up. Bond yields are down slightly, but again, within the previous bounds of movement. Sensitive liquidity indicators like Bitcoin, it's down a few percent. That's nothing. But I think the most interesting thing is that the key underlying rush to security indicator has hardly moved, and that's the dollar.
Yeah.
We hit a 3-year low yesterday, and okay, it strengthened slightly, but it's still there.
It is interesting. So normally people fly to the dollar when they're worried about anything else. And so the dollar strength is what you'd expect. So do you think then that's because people aren't too concerned about Iran, Israel, or is it because the dollar's losing some of its safe haven status?
Well, it's a number of things, but I think ultimately it indicates the degree of headwinds facing the dollar structurally at the moment that got us here. And I think, my personal view, not investment advice, that it's going to drive it lower once this little episode has resolved itself. And I think at the moment, this has all the indications of a regional difficulty rather than a wider escalation. And the Americans in this will have plausible deniability. They clearly knew what was coming, but the evidence so far is that they were not directly involved. And they're saying Israel has effectively gone rogue. Israel is saying these operations will last for a few days. And the confirmation will be what damage is ultimately done to Iran's nuclear facilities that are buried under mountains that require US bunker busting bombs to actually be attacked. It looks at the moment, while these are more in the realms of surgical strikes against Iranian key individuals and command posts, and the Iranian response will be on Israeli assets, not Western assets. Now, that could change, but for the moment, I think that is why we've seen a very sharp rise in the oil price, and the other risk-off moves are, at the moment, relatively benign.
It'll be interesting to see how that plays out over the coming days. But yeah, as you say, if it can be contained, then at least that means it's not going to spill over into other areas of the markets or other areas of the world. What about more broadly, macro-wise, across the earlier part of the week?
Well, US inflation was slightly lower than expected, but it rose month over month still. And the US has largely agreed on a trade deal framework with China. And along the way, Trump sort of decided to just raise the urgency with other negotiators by threatening the imposition of unilateral tariffs. And now is overnight reapplying pressure on the Fed to cut rates, which I think will focus minds on the FOMC meeting, which is coming up next week.
So in some ways, business as usual from Trump. And how about close to home? What about the UK? We had Rachel Reeves talking about the government spending, and we've had quite a bit going on in the local market. What's your view on all of those things?
Well, the UK economy is showing continued signs of slowing, and that's impacting the fiscal position. And amidst all that, we're having a UK stock market, and we've talked about it before, which is disappearing. And I was writing this week a piece that I've called The Attractive Scarcity of UK Equities. Just to sort of frame it, one of the fundamentals of investing is that you should basically look to buy things that are scarce and avoid things or be short of things that are abundant.
Sounds about right. Yeah.
In that context, it's obviously been right over the last 12 months or 2 years or whatever your time frame is to own gold, which is relatively scarce, and not own bonds, which are abundant and becoming more abundant because of people's fiscal difficulties. But as far as equities are concerned, they're sort of in the middle. But right now, I think we're at a period of definitive scarcity of UK equities. And this week was the launch of London Tech Week.
Yep.
We had Keir Starmer on the stage with Jensen Huang of NVIDIA, a company, incidentally, that is about the same size in market cap terms as of the entire UK equity market.
Yeah.
But it also coincided with a series of announcements that all came on Monday, in fact, that I think involved around £6 billion worth of tech companies that are being bought by global investors. And these were Alphawave and Spectris, which were listed, plus there was about $1 billion paid for a quantum computing spin out from Oxford University. And one of the things that broker Peel Hunt talked about was that on their analysis of the M&A and IPO activity in the UK market, and this is just year to date, i.e. in the last 5-6 months, there have been 30 bids for UK companies with a market capitalisation of over 100 million, totalling £25 billion, and just one IPO of a company greater than 100 million market cap. And in the bids that we've seen, the average premium was 43%, which just goes to show the degree to which UK assets are undervalued. Now, you could argue that all the good ones have gone, but I think that's a bit too simplistic. And I think that any company that has survived over the last few years at what the UK economy and its capital markets have thrown at it, and they are surviving or even thriving, must now become vulnerable. And those companies are demonstrably scarcer. And therefore, from an investment perspective, not investment advice, they're more attractive.
You're right. You can always say, oh, all the good ones have gone. They've all been bid for already. But actually, people say that every week. And then the following week, another one or two get offers. So, yeah, there is, in my opinion, definitely still quality out there. There's still a number of great businesses. And as you say, with that premium of 43% that others, mainly American, are being prepared to pay, it shows that there is definitely value across the market. It doesn't feel like there's much coming in our direction which is going to solve that. I don't know whether Rachel Reeves has got any rabbits in the hat or anything that she can apply to solve this problem. What was your view on what she was saying and where the government is in all this and the spending and taxing?
Well, I just think it's all political theatre, really. And I think if Rachel Reeves had been the CFO of a company and her spending review was her annual Capital Markets Day event, I think by the time she sat down, her shares would have been limit down and probably suspended. Not meant as a partisan comment at all, but the misuse of financial metrics used by politicians across the board to obscure the reality of what's going on just wouldn't pass muster among the dwindling and resolute band of investors in the UK stock market. But whatever they say, the UK economy is slowing. Arguably, the global economy is slowing as well. And the UK budget is increasingly under pressure. And there's some really tough choices down the track at the time of the next budget. So taxes are likely to go up and borrowing is likely to increase. And we're yet to know what proportion those things are in. But coming back to the scarcity and abundance point, I don't think it's great news for bond investors.
No.
But of course, all is not lost because the FCA this week has approved a new form of stock market for us all to dive into and get involved in.
They have. Pisces, yeah.
A bit fishy, I think.
You think so? Well, private intermittent securities and capital exchange systems. And yes, as you say, maybe it is fishy. It feels like there's significant risk launching a new exchange, which doesn't feel like there's much symmetry of information. There'll be a lot of well-informed potential sellers, and I imagine they're looking for an equal number of potentially less well-informed buyers of these equities. So there is a high degree of risk, as there would be with any unquoted equity transaction. And it does feel like there's danger within this idea of having an exchange which doesn't trade frequently. It feels like there could well be a lack of liquidity. And I think there's real risk that comes with that. Having said that, at least they're trying something.
Yep.
But I think a number of people are saying that they would prefer if the authorities focused their attentions and efforts on fixing the existing markets that we have in place that aren't really working well, rather than adding another one, which arguably raises risk and it doesn't really fit within the guardrails that exist. So have to see how it evolves.
The fund manager, Stephen English, commented on a piece this week, and he said, if prices is the answer, then the wrong question was asked.
Right.
He thought AIM suffering from a lack of liquidity, this platform seems to offer even less liquidity. Well, it's in the name. The liquidity would be intermittent. Now, AIM might offer intermittent liquidity, which is a bug, whereas this seems like it might be a feature.
I guess the argument is if it's decent liquidity, even if it's not real time every moment, then that's still valuable. But I do agree. I worry that it might be one step too far in terms of the way that markets operate. And I think a number of people have been saying that they prefer the authorities focus on the markets that are already up and running.
And in those markets, what have you been looking at this week?
So, yeah, we've had a small number of bits of news from progressive clients at the small end of the market cap scale. They're all good news, actually, this week. It was Gear for Music, iDocs, and Intuitive Investments Group. Gear for Music, which is an online retailer of musical instruments and other equipment, they announced another opportunistic acquisition of an insolvent competitor. So in some ways, you never want to hear about competitors being insolvent because it suggests the market's under pressure or has been for some time. But Gear for Music does seem to be doing pretty well in their own right and able to pick up these smaller troubled competitors from the administrators. So there's a growing theme there, and I think that they've done well to add another string to their bow in that arena. So it's a piece of good news from them. Then we had iDocs, which is a software business selling mainly into the UK public sector, especially local authority market. They also sell to the global engineering space. They had H1 results through to April. The highlight really was the order intake, which was up 9% year on year, which is a pretty good result for a business in a relatively mature market. They also had good cash generation, and they're hoping to benefit from the ongoing push towards greater use of technology across government in general and local government in particular. So there's some good market trends there. And I think iDocs are riding those quite effectively. And then last but not least, Intuitive Investments Group. This is the owner of a technology platform called Hui10, which is a Chinese business with a very interesting opportunity to help modernize the Chinese state lottery. They raised £9.6 million this week, including participation by their chairman, Sir Nigel Rudd, who I think is quite well known, quite well regarded. So clearly it is a high risk play, but it's now even better funded, and they seem very well connected into that Chinese market. So it's certainly one to watch over the coming months, see how they put that capital to use. And if Hui10 can start to get some traction in its markets, it could be a very interesting stock to keep in touch with. So that was the UK news from our progressive clients. What have we got coming up next week? We've got much to look forward to there.
We've got a rate decision on Tuesday from the Bank of Japan, which is always interesting.
Yeah.
We've got UK inflation data on Wednesday. The market expectation is for a small increase to 3.6% year on year versus 3.5% in April. And I think probably the headliner is going to be the Fed rate decision. And it's going to be a headliner not because almost certainly they're going to leave rates unchanged. I think it's going to be a headliner because of what the Trump reaction function to the Fed and to Jay Powell in particular is going to be, and whether Trump demands Jay Powell's head on a plate as a result of not reducing interest rates, policy rates, as he is increasingly demanding. We've also got a Bank of England rate decision on Thursday, and I think if the Fed doesn't move, I don't think we will either. Then we've got Japanese inflation data on Friday, which is expected to be unchanged at a whopping 3.6%, which in the context of its prevailing interest rates makes no sense whatsoever. But I've given up trying to indicate that the woes of the world are emanating out of Tokyo. But one day.
Let's hope it's not too soon. But
yeah.
But yes, no, we'll be keeping an eye on Japan, and obviously in the meantime keeping an eye on the Middle East and hope things manage to calm down there.
I think that's a good point. I mean, I think probably attention will be mainly focused on geopolitical events and the follow-on from what's happening in the Middle East.
Yeah, but fingers crossed things calm down. So yeah, great to speak to you, and we'll look forward to catching up this time next week.
Okay.
Talk to you then.
Bye for now.
Brought to you by Progressive Equity.